Hello, and welcome to Premium Bytes, where we shine a light on the unsung world of insurance technology leaders. I am Sudhar Krishnamachari, one of your co-hosts, and with Samir Ahmed, our other co-host, we're here to have meaningful conversations about the evolving technology landscape inside the insurance industry. Let's acknowledge it. Being an insurance firm CIO or Chief Information Officer is one of the toughest leadership roles in today's world. You've got a risk-averse mindset baked into the very fabric of the industry, a legacy estate that must complement the modern tech, and a talent crisis from both the retiring side and next-gen recruiting side. And then you got the slower pace of innovation. We see it because we're right there in the trenches with you as consultants day in and day out. Our mission is to deep dive, have conversations that carry substance, offer practical insights, and help you validate and navigate the relevant challenges of being an effective CIO in the insurance sector. So thank you for joining us on this adventure. Let's jump right into our next conversation.
Hey, welcome back, Samir.
Hey, welcome back. How you doing?
I'm doing well. Thanks.
Good.
Good to be back on as we recorded the final episode of the year, so episode number 20, and it's interesting to be in the path with the 20 episodes. So I'm looking forward to it, and this one is going to be slightly different from what we have done in the recent past.
Yeah, that's right. Hard to believe, a year and a half, 20 episodes in, almost. Here we are at the end of 2024. This will probably go out in the new year, but right before the holidays is when we're recording. So what do we have on deck today?
Yeah, so one of the topics that I think you and I have always been thinking about is the idea of MGAs. MGA standing for the managing general agencies. You could probably combine the managing general underwriters as well, but I think they have been in the steady rise in the last few years. If anything, I think there is a lot of InsurTech MGA overlap and a steady rise of startups that are getting into this space and with niche capabilities. And we thought our insurance technology leader audience would be interested in learning, one, who these MGAs are, why they are rising, and what's unique about them. And perhaps there's an element of learning and, innovation angle to this that we can bring back to our audience. So that's the topic. And I guess we have a special guest today.
Yeah, that's right. So we have a guest with us. He's an InsurTech community leader. He's a public speaker, an investor, an author, podcaster, and advises InsurTechs as well. He's been featured in some of the recognizable insurance media like Carrier Management, Digital Insurance, AM Best TV, so on. He's one of the co-founders at InsurTech NY, an accelerator and hub for the InsurTech community, where one of the programs they run is their MGA Lab. He's also a strategic advisor to high-growth InsurTechs, helping them from concept to scale. Previously, he was a director of innovation for the Silicon Valley Insurance Accelerator, led product at Zero, which was a behavioral safety-focused InsurTech acquired by Everest Re. He has a JD from the Mitchell Hamlin School of Law and business and industrial engineering degrees from Lehigh University. So please welcome David Gritz.
Thank you both for having me. Always happy to chat about MGAs, especially to an audience where it's not top of mind.
Yeah. Thank you for joining. How's sort of the end of the year shaping up for you?
It's been good. I thought I was done with travel in November, and then here this week in Iowa, and last week Hong Kong. So finally, I think I can sigh a relief of no more travel for the year. I mean, with the exception of a personal vacation, but it'll be good to be home for a little bit.
Well, that's amazing. That's awesome. We can add world traveler to your bio too now.
Iowa and Hong Kong hopefully were warmer than the bitter cold New Jersey that we're in this week.
Iowa was colder. Hong Kong was significantly warmer.
Okay, good.
Awesome. Yeah, so maybe David, let's just start with a little bit of the basics, right? What is an MGA? What's their role in insurance?
Yeah, so simplest way, an MGA is an organization that an insurance carrier delegates authority or the ability to write business off of their balance sheet. And a good way to like understand that at kind of the next level of depth is to think about the role that an insurance carrier has in order to get a product to a customer. There's really three things that they have to manage. Number one, they have to manage the distribution. So the sale of that policy to the end consumer, which could be through an agent and broker that works for them directly or an agent and broker that's independent. The second responsibility they have is ultimately to profitably price all of the policies, which is also called underwriting. And they have to consistently do that over, a long period of time. And then third, which is probably the unique part of an insurance carrier versus the rest of the value chain, is that they ultimately have to keep a balance sheet that they have to match the liabilities, which is their policies, with the assets they invest, and ideally create a positive return on those assets. So when an insurance company wants to either extend its reach, find specialists that are better than it in a specific market, or experiment with new markets, they oftentimes reach out to MGAs or MGUs. And the idea is that they're going to give up two of the three components of their business. They're going to give up the distribution part and the underwriting part for the MGA to take over. In exchange, they will give them a commission that is better than just the distributor. So if they give their distributors, 10 to 15%, an MGA might get 20 to 25%, with potentially even some additional upside if they do a really good job on the underwriting as a share of additional profit. And they will retain the balance sheet, but there are some circumstances where MGAs actually take some of the balance sheet risks themselves as well.
That's great.
Very good.
Typically they don't do claims and stuff like that, right? Most of them will just delegate that back into the paper carrying insurer.
So we actually just wrapped up a survey on this where we surveyed roughly about 50 startup MGAs. And based on that data, about a third of them handle claims themselves, which I would say is probably a little more unique to these startup, digital MGAs. But traditional MGAs, ones that have been around since the mid 80s, I would say roughly that is correct. They usually give claims either to the carrier's claims department to handle or to a third party administrator.
Awesome.
Gotcha.
Yeah, one thing in this space we often hear about is program administrators. Maybe you can touch on, is that the same as an MGA? Is it different? Is it slightly different? Maybe very briefly we could touch on that.
Yeah, so I would say it's roughly synonymous. And, I think how I kind of bucket it into two or three different categories of MGAs. So there's MGAs that have essentially a single carrier partner that manages all of the complexity of the actual product for them. So in other words, a single carrier has the license or the paper in which that they offer to the MGA that allows them the authority in each state to write business. They manage those filings if it's admitted, if it's excess and surplus lines. They manage the stamping and tax requirements, and all of the balance sheet part they manage themselves, right? So that would be the most simplest, like kind of a basic program administrator. They offload everything to the carrier. A more advanced, this would be kind of in that bucket potentially of like people think a little bit more like an MGU, or I would just call this like a more advanced MGA that's kind of owning more of the stack. So they might be responsible for working together with the carrier on the filings. and they might divide up that responsibility. So they might work with one carrier that's going to act as their paper or kind of meet the requirements for each state regulator, but they're not necessarily using them to actually take balance sheet risk. So they're taking credit risk and they're taking reputation risk. It's their policy. They're meeting the requirements of the regulator, but the actual balance sheet risk they essentially reinsure to another group, which could be a single reinsurer, it could be a set of reinsurers, it could be a set of reinsurers in different configurations, like horizontal and vertical, like stack. And that MGA manages that. And then the last and most advanced is basically what I just explained, except the MGA participates in some of that risk in some form or fashion themselves.
All
Very
right, very good.
interesting.
Yeah, thanks for sharing that. One other just sort of foundational concept maybe to just touch on is, so we hear about fronting carriers, we hear about capacity providers. So what is their role in this situation?
Yeah, so basically, a fronting carrier is an insurance carrier that exists just to offer their licenses, or the term, paper is oftentimes used. And the best way to think about it is paper is like when an insurance policy is issued, like think about the, 20, 30, 50 page document, the first page of it has a name of a company, right? And the name of that company is the fronting carrier, the carrier that offers their paper. So they're literally putting their name in front of the stack of papers. So, the policy form, the deck page, all of that sits behind the paper. That's kind of where the terminology comes from. And then the capacity side, you kind of think about that as the ones that actually is supplying the balance sheet to meet the requirements. So, depending on the state, there has to be a certain amount of surplus and to match a certain amount of premium in case you have more claims than all of the premium, or the claims happen in the beginning of the year versus later in the year when all of the premium is earned. And capacity can happen in different ways. Some fronting carriers that offer the paper participate in offering capacity, sometimes anywhere from 5% to 30%. Those are called hybrid fronts. And then the most traditional capacity providers are either reinsurers or traditional insurance companies that offer kind of the whole package. They offer the paper and the balance sheet altogether.
Gotcha. I'm really curious, in your mind, why is there a sudden attention and a rise and just overall activity in this space? They've always, like you said, I think since the 80s, I think they've always been there. But perhaps, I have a theory that, technology, data, InsurTech, innovation, all of that, it's kind of a wave that is kind of riding behind this MGA rise. But that's just my hypotheses.
Yeah, so
And,
there's really
yeah, just real quick, right? So just to contextualize this a bit further, right? So there's a report from Conning earlier this year, right, where they provided some statistics. So there's in excess of $100 billion in premiums written by MGAs in 2023, which is a 13% year over year increase. And it's more than all of PNC combined, right? So that's just for some context when we talk about the MGA is, a space with a lot of activity and growth. That's sort of the scale of it. But go ahead, David. Sorry.
Yeah, so to answer the original question about why are MGAs more prevalent now than they used to be, I would say there's three and maybe like a bonus fourth reason. So there's a challenge, there's an opportunity, and there's a technology component. So the challenge, and if you look into the history of MGAs, is that oftentimes they're cyclical. And what I mean by that is in times when it's a hard market or it's difficult to get coverage from traditional carriers, MGAs have popped up to address the challenges of the market. So the shortage of essentially products available to serve certain markets. The other thing is there are challenges that are cyclical, but there are also challenges that are essentially part of the broader economic environment. And I'll give some examples, right? So in the broader economic environment, you could say because interest rates are higher, insurers capital is more expensive, so insurers marginally will write less business that takes more specialization and knowledge to be profitable on. So in that sense, that's one of the drivers to less availability of certain products. Second driver, which everyone's probably familiar with, but in the last decade we've had a lot more natural disasters than typically normally happen. So regardless of where you stand on who's at fault for that, someone has to ultimately create a market so people, whether you're a homeowner in Florida or a homeowner in California, you can still get coverage. Or you're in a business that has a supply chain that's been disrupted by COVID, or even some of these differing weather patterns. You ultimately need to get coverage, and a lot of MGAs have stepped in for that. And then on the casualty side of things, people call it social inflation. Another way to look at it is government mandated coverage, where something was not in the policy is now being mandated by a court to be covered. And when that happens, casualty companies, or D&O companies on the financial line side, say, well, maybe we don't want to write in that market. But then enterprising entrepreneurs say, well, that's great that you don't want to write in the market, but we do, and we know how to make money there. So that's kind of the challenge. The opportunity side of things is that back in the day, like you mentioned, like there were MGAs in the 80s, there weren't as many suppliers of fronting paper and capacity. Now there's almost 40 fronting companies. So just if you're an entrepreneur, it's a lot more available to go and find a partner, and some of these partners actually do a fair amount of work for you. Like they're going to help you with your actuarial model. They might have a distribution channel, and they will work with you as an entrepreneur. And there's also different entrepreneurial models. You could be a startup founder and you're starting from scratch, or you can work with some of these affiliated models like applied underwriters, or AmTrust, or Mission Underwriters, which is part of Accelerant, where you might not have all the economics, but you give up 80%, you still have your 20% kind of economics, but you get a lot for that, and you have a brand. And if you know that line of business, you go forth and be successful.
Yeah.
So there's definitely a lot of opportunity because it's easier to do. And then the technology component, which I think is probably most relevant for our audience, is that it's become a lot easier today to start an MGA than it was 10, 15 years ago, because the things that you would otherwise have to build, a policy admin system, rating engine or comparative rater, submission platform, and some kind of workflow automations, those all exist. There's startups and established companies that have basically built those that you can buy off the shelf. And if it used to cost like $1 million plus from Guidewire, now you can get it for 25,000 from Joshu or Loro or Incilion or some of the other newer players in the market. And
Yeah.
the other component of the technology that people aren't really thinking about necessarily is that ultimately what allows a specialty underwriter to be specialty is being able to process data very efficiently and cost effectively, right? And now, there's suppliers like, Verisk, where you can, license their ISO data, and you can get access to it right away. You don't have to necessarily have a friend in claims, or, understand from your own book of business. So you can acquire data easier and you can process data easier, right? There's a lot of tools that are doing data ingestion of old paper forms. There's companies that help you extrapolate, do Monte Carlo simulations, automate your pricing creation. And it makes it a lot easier to go from someone who has anecdotal experience in the market to have like quantitative experience in the market.
Yeah. Hey, I've always wondered if majority of these MGA founders are, and I've only seen founding teams. Typically, it's not a single person, but most of them either come with a very niche expertise in a, specific area of, whatever, right? In poultry farming risk, or something along those lines, where they are really, really niche in a domain or subdomain, or they have a ton of access to some data, either because of their partnership, or they come from another insurance ecosystem play where they've already accumulated a lot of this data. Do you see patterns like that as these guys rise up?
Yeah, I would say that's one of the most common patterns. And in fact, we've had a number of companies that have gone through the MGA lab and they start with some kind of proprietary data set or ability to get data better than anyone else. So, like, one example is a startup pet insurer that was in our MGA lab called For Sure. Their angle is that they have a debit card for pet owners. So, they know everything that pet owners are spending money on, and they provision that debit card to simplify the claims process. So instead of getting the bill from the vet and then getting reimbursement, they can put the money on the debit card and allow you to kind of pay it a lot faster. So if they know everything that you're feeding your pet and all the care that you're paying for your pet, they can better judge how good of a pet parent you are, and understand that risk. So they're essentially collecting underwriting data on people that aren't even their policy holders. So, that would be, one example. Another example, I had a company in the MGA lab called 5x5. And, the founders have, expertise in general aviation. Their focus is kind of smaller planes, worth less than 20 million, but maybe in that like 1 to 10 million range, where the owner of the plane is an individual or a family or a small business, and that person also is a hobbyist and likes to fly the plane themselves. So they have a way to instrument the planes with telematics and use that to ultimately better underwrite, because they know about the performance of the pilot opposed to just generic metrics like claims history, or even just how many flight miles they've had.
That's interesting. One thing I'm curious about, right? You touched on that insurers give up sort of two of the three main aspects of their operations: distribution and then underwriting, and in return they get specialists in the domain that can bring business and maybe provide some diversification. How is this sort of relationship between the MGAs and the carriers changed over time, and in particular in light of sort of technology enabling more collaboration?
Yeah, so there's a few ways that it's changed. I think the first way that it's changed is like old school MGAs. The reason why they started it is because it was pure relationship, right? So if you were a commercial broker and you were really good at insuring horse farms and you had a ton of horse farms on your book, they might, like, one of the property underwriters or casualty underwriters might say, great, like, why don't you put together a program? You can help us come up with a better pricing and better underwriting guidelines, and go forth. And that broker already had the book of business. They already had the relationship with the underwriter, and the reason why it formed was relationship based. Today, with MGAs, there's MGAs where they are specialists, they have better data, but there's other MGAs that exist, and the only reason why they exist because technology allows it to happen. So, for
Mm.
example, one of the mentors in our MGA lab is a guy named Andrew Bate. He runs a company called Safely. Safely offers vacation rental insurance to homeowners and property managers. So if you put your house for rent on Airbnb or VRBO or your own site, you would like to make sure it's covered if, the people come in and damage it.
Yeah.
And in the past, like, there was no single point of doing this, right? There was no technology that integrated into your booking management system and could price things on a per night basis. And they can write policies as small as $5 for a single night in, on a inexpensive place to, it could be leasing out a castle for a year. And, having the technology that could ultimately collect the data, integrate with the, booking management software and integrate it across multiple distribution channels was just simply not possible. So if you were a company in that business, right, you couldn't really do it. And that's now what startups do, is they unlock new forms of distribution or new products that are heavily reliant on software in order to drive them. So, vacation rental is one. Another big area is parametric insurance, which is essentially insurance that is paid out kind of in a yes or no. There's no, complex claims adjudication process.
Simple algorithmic adjudication, I guess. Yeah.
Exactly. So we have a company that was in the lab called Sola. They do tornado deductible buy down. So if a tornado hits your house, they cover up to 15,000 of the deductible, and helps you get your place fixed up, fill in the windows, whatever you need, clear out the debris in the yard, and get back to some semblance right away. And they usually do payouts like within a couple days. So a traditional insurer is not set up for parametric. They don't have the capabilities to offer that, and startups allow them to offer that. Or maybe um, structurally they're not able to reduce their deductibles, but this startup can come in and kind of fill the lower gap and then get an aggregation and offer it to the reinsurer. So it creates a new capital structure to make it possible.
Yeah, that's
Yeah.
very interesting, David. I think you touched on some of the sort of opportunity that is sort of behind the proliferation of MGAs and the growth. What is it that prevents carriers from actually taking advantage of these opportunities? And maybe paired with that, right, if you can also touch on, should a carrier really think of partnering with MGA as an opportunity, or should they feel threatened by it?
Yeah, so I mean, the primary reason why carriers don't do this is because the cost of setting up a specialized team, right? So if a carrier was going to stand up a 10-person team that was, distribution oriented people, underwriters, tech people, and, there may be some other ancillary supports people maybe claim. So 10 persons at a carrier, fully loaded, it's probably like, $1.5 million to $2.5 million a year, and probably takes 3 years to get any traction. So you're talking, bare minimum 4.5 million, probably up to a 10 million investment, right? Versus an external MGA, founders are very crafty. We've seen MGAs get started with as little as like, 3 people. Some of the founders might be willing to work for very little money or predominantly self-fund it. So they can get off the ground between as little as $500,000 to $2 million, maybe even less in theory. And they're not tied to the carrier systems. They can use lower cost pre-built software for 25,000 instead of having to provision another license on the carrier's guide wire. And ultimately, because of the nimbleness in all of those factors and being able to access external capital, whether it's private equity, venture capital, angel capital, they can essentially get started faster with less resources, and ultimately not be tied into some of the restrictions of a carrier's distribution model, right? Carriers have concerns about upsetting their existing agency channel every time they launch a new product. A startup can do it however they want. So I would say that's the reason why generally carriers can't do it. That being said, there are carriers that do have models where they do incubate their own MGAs internally, and Vantage Risk is kind of an example where they do stuff like that. And I mentioned a few others, Accelerant's business, Mission Underwriters, Applied Underwriters. There's definitely several that fit in that bucket. So there are some carriers that do it. They're definitely rare, but I don't think carriers should be threatened by MGAs at all, because ultimately the success of a carrier from my perspective is on two things. One, how good overall they are at underwriting, and two, how good they are as stewards of their balance sheet. So if they can find an MGA that runs at a lower loss ratio than their primary business, then if anything, they're going to be better
They'll
off
just take
because
it. Yeah.
they can lower their combined ratios, and ultimately it allows them to go into areas that otherwise traditionally might be channel conflict that now they don't have to worry about because that MGA handles the distribution.
Yeah, that's all very interesting, David. With your comment about MGAs having the ability to be more nimble, being able to take advantage of technology better than traditional carriers. Um, I think both of these are aspects that are aspirational for traditional carriers, right? Be more nimble, not have 18 months for a modernization type of project. Why can't we do it in 9 months or 6 months or, uh, heaven forbid, we did it even faster
Right.
because this MG out there is able to get up and running so fast. So what is it that you think operations folks, particularly tech operations folks, can learn from how MGAs have been able to capitalize on technology?
Yeah, so this is my primary thing that I've seen with almost every carrier is like they have this whole build versus buy thing, and a lot of times they think, we're definitely a buy shop versus, a build shop. But if that was truly the case, it was truly the case, they would have a skeleton crew, and they would be the best vendor managers ever, right? Like they would be able to get a new vendor in, approved, all things signed in 1 week or less. I've
Yeah.
never met a carrier in the history of every carrier that I've ever met that has that ability or takes that framework. There are definitely other corporates and other industries that exist and have the capabilities to do this, whether it's in more complex manufacturing, like auto manufacturing, it's in consumer goods, but it's just not in the DNA of a carrier to do that. So I'm not saying people in operations should strive to get new vendors in 1 month or even 1 week. Like maybe that's not even good for them. But I think what you should, but if you compare that to a startup, if a startup MGA wants to make a decision, they could make a decision in 3 days, right? And then that now becomes their new policy admin system or their claim
They're
system.
not, I guess,
And
inundated by the corporate,
right. And they're
you know.
okay if like it fails and then they have to start over again because the net cost of failure is pretty insignificant when they're at a small scale. So I would say if a carrier wants to learn from startups, number one is you need to have a separate track for new product development, for adding in new vendors. Don't ruin the risk management of your whole business by doing this for other things. But the rule of thumb is if it's less than 1 million in premium, the absolute risk to the organization is small. So you can have a different fast track to puzzle piece things together, to buy other systems, to experiment and just see what happens, right? Once it gets to 1 million in premium, then you could start to, establish your traditional processes, but you got to run, an independent system. The second thing is, don't try and get people on the project that have 3 other jobs, right? You're better off hiring an external consulting firm that specializes in technology development to do it for you than to give, Joe or Susie that already has like 2 other jobs, right? So, I mean, if you do want to do it yourself, take all the other things off their plate, let them be free and just work on this, right? So you need to really have the kind of independence of responsibility and focus, just like the startups have the focus, right?
Yeah.
And then the last thing is like, you got to set the incentives aligned with where the business is, right? Like if you're in a division where you don't move the needle unless you get 100 million in new premium, you can't judge people on their startup doing 100 million in new premium in the next year. Like they're a net new business, so you got to judge them at their level of scale. If they get to 2, 3, 4 million in premium in the year, they should be celebrated. So they need to
Yeah.
be cordoned off separately and judged separately for their performance in a vacuum, not within the business unit that they reside, or the cost center that they're in.
Yeah.
That's awesome, David. So, hey, look, we've used up quite a bit of time here, covered a lot of ground at the same time, right? We talked about some basic things around what's an MGA and how they operate, and what parts of the insurance operations they take on versus carrier keeps. We've talked about some of the challenges, the opportunities, the role of technology in proliferation of MGAs recently, and why they've seen significant growth. We talked about some of the spaces in which they're operating, and how insurers can think of them as truly partners and not feel threatened. And then at the end here, we touched on things that our tech leaders can learn from them in terms of how to bring in technology faster, how to roll out products quicker, how to accelerate their innovation. So I appreciate all the commentary and insights. Is there anything that you think tech leaders should know that we did not touch on?
So if you give me room for a small self promotion, we do have an event coming up, first week of April, our InsurTech Spring Conference. So we do have a fair amount of content on MGAs, but we definitely have a lot of content that tech leaders could benefit from. So would love to see you at our InsurTech Spring Conference.
Awesome.
Yeah, highly
We'll
recommend
look forward
it.
to participating.
It's a well put on event, and would love to see all of you in the audience at the event.
I just have a curiosity question, just a fact question. How many MGAs are sprouting a year in the last 5 years? Just if you box yourself to just US.
Yeah, so the data that we have, there's roughly about 205 startup MGAs, and roughly, if you say that they started since 2015, so obviously there's been some exits, there's some that have become carriers, there's some that have closed, but roughly about 20 to 25 a year. Some years are higher than others.
Gotcha. That's great. That's a great closing fact to end this conversation. So thank you. We really appreciate you joining us. And we look forward to having you again, perhaps at some point next year with perhaps some more updates of what's happening in your circuit. But thanks to the audience for joining us. And as always, like, comment, share, and subscribe, and engage with us in various channels. And we'll look forward to seeing and speaking with all of you on the next episode.
And that's a wrap for today's conversation on PremiumBytes, where we shine a light on the unsung world of insurance technology leaders. Thank you for joining us on this adventure and being part of our community. Don't forget to like, comment, subscribe, share, and follow us. Until next time, take care.